From Barangaroo Studios, the Ausbiz COB is the key stuff you need to know about the day in business and finance.
Well, that says it all, doesn't it? The stuff you need to know about the day, and I think the week as well.
Yes.
I'm Nadine Blaney.
I'm Juliet Sally, TGIF.
Well, cheers to that.
Cheers. When Kylie's away.
Yeah, it's been a big week, hasn't it?
It has. We needed that. It's been a huge week, but a good week because in terms of market action, I mean, obviously
terrible
some terrible things in terms of the humanitarian crisis and the volatility, etc. But the market actually is up about 1.4% over the past 5 days, even though today was a down day.
Yeah. So it looks as if we'll close down by about 0.6%. Of course, the last of the day's trades are still going through the ASX. So I don't want to, take anything away from that. But the COB Australia Index has closed down by about that much. What I thought was really interesting this week, Juliet, was the sort of whipsaw conversation around the Fed and Fed rate expectations. So began this week with a lot of Fed speakers kind of sounding like maybe, the bond yield parabolic rise of last week was doing the heavy lifting for them, maybe take their foot off the pedal. We always knew that the inflation read was going to be a big one, but
it was hotter than expected, and a lot of that driven by rents, which is really fueling a lot of the pain for Americans, for Australians as well. And then when you tip in the fuel prices and the further volatility that we are expecting, I think a lot more people now are saying, look, maybe the Fed isn't done. Maybe there's one more hike. Some people saying potentially even two. But as Clifford Bennett from ACY Securities was just telling me, we just have to focus on that long part of higher for longer. We really have to look at the fact that these, what he calls normalized rates, because we did have free money for so long, are here for a longer time.
That's right, because whereas we may get one, we may get two more rate hikes here in Australia. I mean, I haven't spoken to anybody who's thinking that rates are going to be cut anytime soon. When you see the stickiness of inflation, which we do have a quarterly inflation rate, coming next week. So I'm no doubt we'll be talking with our guest host about that one, what's to come in a big week. But yeah, for today, it was a bit of a Friday fizzle. Let's not, sugarcoat that. And of course, the conversation around the Fed and inflation, but also China.
So China, and I think Mathan was making a good point there, that you have these multi-year highs in terms of inflation for the US and multi-year lows for China, which is very much still in this disinflationary environment. And we actually saw a negative increase in terms of that CPI on the year. And then when it comes to business inflation, or that PPI factory gate, it's still very disinflationary, negative 2.4%.
And recall, we started this week talking about the potential for potentially more, significant stimulus coming in China. Well, we haven't heard that yet, have we? So maybe it's something that we'll be discussing next week as well. So today, I think that the market action was pretty reflective of the narratives that we've just been delving into. We had some of those interest rate sensitive areas of the market really getting hit hard, and that included the REITs. And so that was, I believe, the worst performing sector. 9, I think, out of the 11 sectors were negative. And tech as well. Tech was one of those sectors that got hit. We saw the NASDAQ down the most in New York.
Tech down about 2%, so certainly following on. Yeah, as you say, REITs, pretty similar there. So what we're seeing there is those tech players. Block, the Australian listed shares of Block down by 1.7%, WiseTech Global off by 1.3%. But when you look at the actual sectors, we've only got 2 in the green today.
And that is, one of them is healthcare. A little bit, I could say, of a defensive play. Interesting to note that we saw CSL coming back to life a little bit today, but we'll talk about it in the corporate stories. ResMed still getting battered and bruised. And again, the conversation, I can't tell you how many times I've been speaking with people. Heath Moss from HLM Investments was one today saying, it's a huge buying opportunity. And he reckons that CSL yesterday was a really big buying opportunity as well. So it's just really interesting, the dynamic. And we're also a little bit in a vacuum when it comes to corporate stories. I'm not going to, we're sort of after reporting season.
Yeah, it was a bit hard to scratch around for some of them today, I have to say.
Pact Group was one. I mean, it has said that the offer to take it private does not value the company and that it's not going to be acceptable as it stands.
Yeah, and we were talking about ResMed, of course, near that 52-week low. What was the story with Perpetual?
Well, it updated on funds, and it's actually seen some funds inflows, so that's good. I mean, I've said it too many times probably for regular viewers, but everyone I speak to, if you're looking to invest in a fund manager, follow the flows. When the flows are going in, that's good. When they're out, that's bad. Magellan, looking at you. Big had a broker upgrade. ResMed, broker from RBC Capital, again weighing in negatively on the stock, and you can see what happened. And then I think CSL,
bounced around.
Worthwhile sort of pointing out that
I did have fun telling all our I guess you're not an Australian born and bred either, the Bigger Cheese ad that I used to love.
What is that?
You didn't know that one? So
No.
there's all these towns in Australia, so like Collector, Robe, all of that. And there was this fabulous ad that used to say Collector isn't famous for collectors, Robe isn't famous for robes, and then it was Bigger is famous for bigger cheese. And nobody knew it in the newsroom except me. I felt very old.
Wow. Yeah. Look, it skews young in the newsroom regardless. Anyhow, the stock of the day was Self-Wealth. This one flew under the radar a little bit. The shares were up. Sorry, I should have checked most recently. Last I checked, about 20%, because there was a media report that Stake had made an offer for the company. Well, in fact, it did. Self-Wealth came out today, said yes, Stake had made an offer, but that they did not see it as being in the best interest of shareholders. So it was a stock of the day. Claude Walker from A Rich Life, Luke Winchester from Merriweather Capital.
Negative on that though, and I think I view it a lot like the insurers, where you get a short-term boost from interest rates rising and being able to sort of skim that difference. But over time, the competitive nature of this industry eventually kicks in. And as an example, I mean, I am on an email list for Interactive Brokers, which is a US-based brokerage firm, and they're advertising 5% on clients' cash balances. So they're passing on the full sort of interest rate differential. And I'd expect local players to over time do the same as they look to sort of grab whatever market shares left and consolidate the space. So I don't think that's a great moat. I think the rest of the business isn't doing too well. How do you reconcile that with a takeover bid, and is it worth more, and how will this play out? It's actually really hard for me to say. Usually with stuff like this, I take a little bit off the table. You've had a takeover bid come in, admittedly knocked back. The share price has bounced though, so you can sort of take some off, lock some in, and maybe continue to hold and hope that Stake comes back or someone else. I mean, this is a space where there's quite a few players. I mean, ComSec by far is the big gorilla in the jungle.
So I don't see them necessarily selling out, even though that, in my personal opinion, it's not a stock I'm long, because I don't think it's the best quality business. It's very hard to make a sustainable profit and grow, because it costs a lot of money to acquire customers. But that's my take on Self-Wealth.
So just to add a little bit of color, both said, if you're a holder, you should trim some profits on a day like today, because we've seen such a share price rise. But yeah, talking about further consolidation in the sector, it kind of makes sense. There's a lot of players out there. So they've said that, there might be another bite at the cherry, if not from Stake, but from even ComSec, something. We'll see.
All right, Shane Oliver joins us.
Yeah.
Welcome.
Hi.
Happy Friday. Happy
you.
Friday.
Cheers to you.
You too.
Yeah. So we were just saying our newsroom is skewing young these days, making us feel like we've got a bit of history behind us.
Yes.
History would tell us what when it comes to the Fed's reaction to the inflationary pulse still?
I think the history tells us that it's time for them to sit pat.
Okay.
I mean, this is very different to 18 months ago, when inflation was surprising on the upside consistently and monetary policy was easy. Now you've got inflation sometimes surprises on the downside, sometimes on the upside, but the broad trend is down. But more importantly, monetary policy is now very tight. It's a radically different environment to the one we had a year ago or 18 months ago. And so I think that calls for patience by the Fed. And it's exactly the same story in Australia. I know there's a lot of worry about the war in Israel and the potential impact on petrol prices, but again, radically different to the situation when Ukraine was invaded and petrol prices went sky high. It's totally different situation. And I think when you look at those inflation numbers, they weren't that bad. The bulk of the surprise was fuel. We knew that one. And of course, shelter. And all the evidence in the US points to falling rents going forward, or at least a big slowdown in rental inflation. So I don't think we should get too concerned about that one, and I don't think the Fed will either. I think the more likely scenario is that the Fed will continue to sound hawkish. I don't think they'll raise rates in November, but they will maintain the message about being high for longer, for the time being at least. And then as we go through next year, eventually they'll change their tune and then have to cut by more, but we're not at that point yet.
Shane, how did you read the data coming through from China? Because still deflationary pressures there at the same time you're seeing hotter than expected inflation from the US. So still this, I guess, divergence from the two big superpowers.
It certainly is, and confuses people a little bit. But I think China is suffering from excess capacity, excess savings. They need to spend more. They're not doing that. They're reluctant to do that because the levers they used to pull don't seem to be working anymore, or not working as well. And so that presents them with a problem. But I think China's situation is radically different. But quite clearly here, there is room for more spending in China and more stimulus. And I think that's ultimately what we will see. When you look at those inflation numbers, CPI at 0 was less than expected. Producer prices still falling, albeit a little bit less than expected. But nevertheless, that is an environment where you can still afford to pump more stimulus in. There was some news on that front earlier in the week. I think Bloomberg reported that people familiar with the matter, the old people familiar with the matter, were indicating that there'd be some sort of consideration of borrowing $1 trillion to put into an infrastructure, which is a massive amount of money. Their economy is $18 trillion, so it's a big chunk of their economy. So I think that was way over the top. But it's the sort of thing you'd expect to see, some sort of stimulus coming through. But here we are at the end of the week and we still haven't seen anything concrete announced.
Okay, can we get to equities? Well, today we've seen the sell-off. We've just talked about why. But overall, up by about 1.4% for the 4 trading days, or for the 5 trading days. And it was a 6 session stretch of good gains. So what have we bottomed? What do you make of where we're at in markets?
Well, it's an interesting question. I posed that question in my weekly this week. Have we bottomed? And I must admit, I'm a little bit confused about it. It seems to me there were conditions in place for a good bottom last week. The US share market had fallen down to its 200-day moving average. Markets were oversold both here and in the US. It was the sort of area where you can get a bit of a bounce. We got that bounce Friday night with those mixed jobs numbers in the US, which I think just confused everybody. We got lots of bad news this week, obviously, on the Israeli situation. And of course, market rallied. So that's a positive sign. Only thing is that, and of course, it was supported by the Fed commentary, which was saying that they would take account of the tightening of monetary policy flowing from higher interest rates or higher bond yields. So all well and good. The only problem is that there's still a bunch of risks out there. It could have just been a dead cat bounce from an oversold level. The breadth of the rally that we've seen so far has been fairly narrow. You've still got those issues regarding Israel to work through. A big issue there is whether Iran gets bought into the crisis, and then it would affect oil supplies potentially. Bond yields are still too high relative to earnings yields, so either bond yields needs to come down or earnings yields need to go up, which means price to earnings multiples fall. There's still uncertainties about monetary policy and so on. So it's still a bit messy. But I am conscious, if I look at our inflation indicator, which you may have seen in our weekly report, it's still pointing down. Same story for Australia. It actually improved last week because of the NAB survey showing lower cost and price pressures. So that, I think, is the key in all of this. If that continues to improve, that will take pressure off central banks, including the Fed and the RBA, ultimately enabling better conditions as we go through next year, and any recession that flows from all of this to be relatively mild.
Shane,
but obviously, sorry,
I was just going to say just a quick one on the dollar, because it did get hammered on the CPI data. It's come back a little, but the consensus calls out there are so different as to whether or not it falls through 60 cents, whether there's going to be a bounce and some resistance there. Or Peter Dragovich from COB was saying to me, look, fair value is 67 cents.
No, that's too low. Like fair value is always in the eye of the economist looking at it, and it does vary around a little bit. But I reckon fair value on a simple purchasing power parity basis of relative prices is around 73, 74. Commodity prices can move you around that level, but I think we're well below what I would consider to be fair value. And that's even when you allow for the fact that commodity prices may seem so-so, they're still relatively high in a big picture sense, and the terms of trade is very, very strong. That would suggest the Aussie dollar should be higher. Now, working in the opposite direction are two things. Obviously, the interest differential is pulling it down. That won't last forever. I think the Fed, sooner or later, will have to sound more dovish. Maybe not this year, but as we go through next year. The other factor pulling it down is uncertainty about the Chinese economy. But if you get stimulus coming through out of China and more confidence about China, that could push the Aussie dollar higher. So my view is very short term, bit unclear, very messy, but I would use any further weakness from here as a buying opportunity, because I think as we go through next year, as we start to look beyond this sort of growth downturn or slowdown that we're seeing, commodity prices are probably going to stay high. We've still got massive underinvestment in mining, particularly metals, more defence spending. All of those things are positive for commodities, which are therefore positive for the Aussie dollar.
Shane, can I just sneak another one in? And I know it's a Friday and everybody's ready to go home. But we've obviously got, inflation here locally next week, but it's earnings season, big time in the United States. So what are you going to be looking for in the commentary primarily when it comes to some of these big corporates?
Well, I think like we were in Australia just a month or two ago in August, how they're seeing the outlook, how their margins are going to hold up, what cost pressures are doing, what they're seeing with demand. Like, I actually think this profit reporting, this is an argument to be a little bit positive, if you want to put it in that camp, that so far when we've gone through the profit reporting seasons, analysts have proven to be too negative, and then we get this upside surprise by more than normal. The US companies always, on average, surprise on the upside. You always get a bit of that, but they've been surprising by a little bit more than normal in recent times. And I think you'll probably see that this time around as well. We have seen the US economy hold up a lot better than expected, and that will help profits, I think, in the US. So if you're looking for something that might support markets, then it could be the profit reporting season. But yeah, you want to see corporate commentary remaining reasonably upbeat, but not negative. You don't want to hear companies saying, well, things are collapsing. That would be a major problem. And I probably don't think we're going to hear that. I think the companies will be a little bit subdued, but probably a bit more upbeat than many investors are.
And Shane, just finally, you've moved down the bookshelf again. What is Shane Oliver's book club pick for the weekend?
Well, at the moment, I finished that fantasy novel I had last week. I have moved down the shelf. I think I've got the bag of that Guinness sitting there.
You've got the Dalai Lama, which we all sort of need a bit of at the moment.
Yeah, we do need a bit of that at the moment. Oddly enough, I'm reading this book called Just One Thing, this health guy, Michael, his name now. And he's got all these interesting tips in terms of things you should do to maintain your health. So I practice standing on one foot while doing my teeth every night and making sure I have an apple a day. Try to do 40 push-ups every morning and 3 to 5 minutes of sit-ups. And I'm told that those things will maybe help me make it to 100.
That's why you look so like good. Shane Oliver, AMP, you legend.
Indeed.
Have a good weekend. We'll see you soon.
Okay, you too. Take care.
I think we need to take
some of
his advice.
I know. I was like, I just did a push-up. Yeah, I did a what do you call this? A bicep lift.
Sounds like you do them a lot. Okay, let's get to leaders and laggards just quickly. We talked about this a bit. Brain chip, you never really know why. One day it's up, one day it's down. Perpetual Bega, that was a broker move as well. Yeah. And there was a bit of love for some of those in the lithium space today. But the laggards, there's Core Lithium. I didn't see any news particularly.
But Chalice Mining again. It's there one day, it's there next. And Sayona Mining down 4.7%. Let's have a look at some of the small cap leaders and laggards as well. Strickland Metals up 14.5%. 40S Memory up by almost 8%. And the laggards,
Gavy Jennings did a cap raise this week, very heavily discounted. I would love to impress you with my memory on these other ones, but I can't say I.
Demex Resources we covered earlier.
Yeah, that's right. So it did have some news out today. And let's get to what we're expecting, not tonight, but the week ahead, because we've got some punchy things here. We've got the September jobs data that comes this week. I think inflation week after next. China, and then a whole host of data points. In the US, which we've got a data-dependent Fed once again.
Indeed. All right. And of course, that is what we're looking out for next week. Let's have a quick look at the market now that it has actually closed. Down for the day, but as we mentioned, a 6-session rally. The COB 200 down 0.7% on the close. When it comes to the ASX 200, as we mentioned, 9 of the 11 sectors lower, and it is down about 0.5%, so dropped 40 points on the close, 7,051. Over the last 5 days, though, it's up 1.4%, and as we say, pretty much every single week, unchanged year to date.
Yes, and I will note that, E-minis in the States are mildly positive right now, so we'll see what's to come. We'll be keeping a close eye, obviously, on what's happening in the Middle East with Israel and the Hamas conflict. Obviously, very sad times there, but obviously gold, oil will remain a focal point, as we look forward to seeing you once again on Monday morning. We hope everybody has a happy and a healthy weekend.
Yes,
we'll see you then.